For 3 years now, Swiss banking regulators and many of the bank's shareholders have been telling UBS that the complex operations of its trading division may be more trouble than they're worth. In 2009, losses in its investment banking unit had brought UBS close to bankruptcy. And last year, an alleged rogue trader, Kweku Adebole, caused it another $2.3 billion loss. Over the next 3 years, UBS plans to wind down most of its bond trading activities and its trading in derivatives, securities, commodities and interest rate changes. It's expected that 10,000 people will have to go at its London offices and at its offices in Zurich and Stamford in the USA.
These types of fixed income flow businesses, commodities businesses, they use a lot of capital, they blow up the balance sheet. So those are being attacked. The second aspect of it is the Swiss banks are trying to find an investment banking model that fits neatly with their core business of high net worth banking. And these are businesses that don't have a clear tie-in to high net worth banking.
The question many are now asking is how UBS's bombshell, as it's being called in banking circles, will affect the rest of the sector in Switzerland and abroad.
Regulators across the world have actually been encouraging their banks to de-risk, particularly in fixed income, which is a big user of capital. But maybe what we see from UBS will perhaps make them say, well, maybe we've just been a little bit too light on the tiller on this issue, and maybe we should push it rather harder and actually look at some of these banks exiting the business altogether in the mode of UBS.
Britain, like Switzerland, has a banking sector with revenues 5 times greater than its national income. Following the news from UBS, large and troubled British banks like RBS might come under increased pressure to scale back the scope of their activities. Jeremy Howell, BBC News.